Now I'd like to talk about a fairly technical issue, which is the toolkit that modern central banks use for what's called monetary policy, effectively trying to stabilize the value of currency over time so that it retains its purchasing power and that people don't lose faith in it as a long-term store of value, which of course would undermine their demand for it and negate the benefits of seigniorage that governments and central banks enjoy. So we're going to be looking at three different techniques that are used for monetary policy, or the trying to establish the stability of prices. The first of these is changing the reserve requirements of commercial banks. Effectively, since commercial banks can be a fraction of what they borrow, with the rest being held in reserve, the larger the fraction that they have to retain, the less money there is to recirculate in the economy. Another technique is by actively borrowing and lending funds in the market, effectively becoming a participant in the interbank loan market to ensure that there is sufficient money available to make all of the loans that people would like there to be, effectively trying to constrain interest rates by either lowering them or raising them by making funds more available or less available in the interbank market. And finally, we have the idea of what has been recently called quantitative easing, expanding or contracting a central bank's balance sheet by buying and selling assets which it uses to underpin the value of its currency. By buying more assets, it's able to print up more currency. And when it sells off assets or shrinks its balance sheet, it decreases the amount of currency that's available because there are fewer assets underlaying it. So let's take a slightly more detailed look at this, just to make sure that we understand how these various tools are used in the modern world. The first one I want to discuss is the notion of reserve requirements, the idea that a bank will only have to retain a portion of the money that is deposited in it. Meaning that, of course, they are free to lend the remaining portion on to other people, effectively allowing currency to recirculate. A deposit, as you can see roughly here in the graphic at the top of this slide, shows that if we deposit $100 in a system that requires a 10% reserve, then as much as $90 can get lent out, which may in turn get deposited into another bank, which requires of that $90 that 9 be held in reserve with $81 lent back out. And this process continues iteratively. If all money that is loaned out finds its way back into the banking system, and we make as many loans as possible based off of our reserve ratio and currency, what we'll discover is that there is a relationship between these three variables of money supply, currency, and the reserve ratio. If we divide the currency by the reserve ratio, we see how currency can multiply the money supply by simply recirculating the same pieces of debt. Now, this is often complicated for people who are unfamiliar with how monetary policy works, because on a complete expansion of our monetary base using, say, a 10% fractional reserve, what we would end up with is 10 times as much money as there is currency. And this tends to freak people out because when they think about it, there are hundreds of dollars worth of debt, but only $100 worth of currency in the economy. But they fail to forget, they fail to remember that if I pay back my $100 loan to you, then you can pay back your $100 loan to someone else, and they can in turn pay back their $100 loan, meaning that $300, $400, $500 worth of debt could be collapsed using the same unit of currency. I don't need a separate $100 bill to pay off every separate $100 debt in the economy. We don't actually destroy and create currency every time a transaction takes place. We recirculate the same token over and over. So what's being measured here is the extent of transactability. Because remember, you don't necessarily need coinage or bills in order to transact. So we don't need cash to transact. Once I have deposits in a bank, now I can settle my transactions via that bank's ledger. And I can settle up with other merchants or other consumers who might be using other banks by having our two institutions be connected through a central. So this is the technique that we used to use in Canada. Used to use this in the States until the 1980s. For the most part, though Indian and Chinese central banks still use this system. Both the Reserve Bank of India and the People's Bank of China both regularly make adjustments to the reserve ratio of commercial banks in order to either encourage economic activity or to slow it down. The biggest problem with the model, though, is that it assumes that all currency is eventually deposited back into the system, That works particularly well if banks, traditional banks, are the primary savings vehicles for individuals. On the other hand, if they use other things like money market mutual funds or life insurance investments as a place to park their cash, then the money does not necessarily get multiplied through fully in the banking system, as is assumed here. The reason that the Indian and Chinese central banks are able to still make good policy use of adjusting reserve ratios is because of the intensity with which financing flows through banks in those countries and the level of usage that the banking system has by everyday individuals. The next type of monetary policy I want to talk about is something that's a little bit more modern. We first started seeing this in the early 1980s. It's called inflation targeting. Rather than trying to stabilize the value of money by setting the quantity of money, effectively trying to match supply to demand, which is changing all of the time. Instead, the Reserve Bank of New Zealand had this particularly clever idea that if we wanted to control prices, maybe we should just focus on prices. If we're worried about the rate of inflation, if we're worried about prices rising too fast or falling into deflation where prices are falling, they actually argued that the best way for us to do this was to look at what the price of money was, arguing effectively that the price of money was the interest rate that you paid to secure it. And therefore, if we were to try to adjust interest rates, we would be able to adjust the relative value of currency or the relative availability of currency for both businesses and individuals. If we want to make currency less available for people so there are fewer transactions and prices don't rise as quickly, then we raise the interest rate. If we want money to be more readily available, which will drive more transactions and more economic activity, probably push up inflation a little bit, then we tend to lower interest rates. And so the idea here is to focus on setting our interest rates appropriate to get inflation to a particular level. And this means that as long as inflation is low, interest rates generally don't move. If inflation begins to rise above its target, then you'll see central banks raising interest rates to try to cool down the economy. And when inflation falls below its target, then you'll see central banks trying to encourage a little bit more inflation by lowering interest rates or providing other forms of stimulus. Now, a more sophisticated version of this is under review. It's what's called price level path targeting. And you can see an image of what it broadly represents above. When you engage in inflation targeting itself, the goal becomes to very quickly move us back towards a fixed level of inflation. But if we think about what inflation looks like on a multi-period model, we would have to recognize that it involves prices rising at a particular rate. And so the goal of price level path targeting is to try to focus on restoring prices to that particular path, as opposed to necessarily rapidly moving inflation back towards its target, which can in and of itself lead to quick changes in interest rates, which can do things like spark recessions. We had this happen in the early 1980s. We had it happen in the early 1990s. And so when inflation started to rise quickly, central banks took corrective action that induced recessions. They got inflation under control, but also had a real cost in terms of jobs for a number of months. Now, price level path targeting takes a little bit less of an extreme view of this. Rather than simply trying to very quickly move back to a 2% inflation rate, regardless of the consequence, they try to move prices back towards their path, which means that after a period of particularly low inflation, they might actually want to induce periods of high inflation above its target in order to restore prices to the expected path. Similarly, if prices rose dramatically quickly, they would try to raise interest rates and constrain that to move prices back towards the path, not necessarily forcing them back towards a 2% inflation target. Now, this type of technique is still under review by a number of central banks around the world, including the Bank of Canada, but it has yet to be widely adopted, as researchers are still sort of divided as to whether or not this constitutes an actual improvement over the inflation targeting that many central banks have been using since the early 1980s. And this leads to my final technique for engaging in monetary policy, which is quantitative easing. Now, quantitative easing has become a lot more famous since 2008, but strictly speaking, central banks have been using quantitative easing for some time. It effectively involves making a collateralized loan based on longer-lived assets then are usually accepted. Normally, when a central bank asks for collateral in exchange for, say, an emergency loan, they're generally looking to accept short-term, high-quality debts like government treasury bills. It's unusual for them to accept long-term government bonds onto their balance sheet. They have some, but typically central banks own short-term government promises, which are the most stable in terms of pricing. Uh, so when we talk about quantitative easing, generally what we're looking at is banks buying up longer term assets and in exchange creating short term reserve currencies that can be used by the various members of the banking community in their country in order to transact with one another. Effectively, quantitative easing is designed to free up loanable cash within banks that is otherwise tied up in long term debts. For instance, banks that had all of their short-term funds that had been, for instance, tied up in mortgages were able to sell these long-term debts and mortgages to the central bank following the 2008 financial crisis in exchange for reserves, which they could use to transact with one another. So there is a slight difference between quantitative easing and printing currency. They are not printing currency when they engage in quantitative easing, but for all intents and purposes, they are increasing the money supply by expanding the asset base of the central bank, which means they could issue a lot more currency than they necessarily do. So central banks have been cautious about increasing the amount of currency in circulation, but with the use of quantitative easing, they have significantly increased the reserve credit on their balance sheets, which allows banks to transact with one another. The effect of quantitative easing has in general been to reduce long-term interest rates, which was the objective of this policy. Most of the time when we talk about things like changing reserve requirements or inflation targeting, we're usually focused on short-term interest rates and making sure that short-term interest rates can be used to control short-term inflation. But when we're looking at longer term interest rates to say provide relief to mortgage borrowers over the last decade, what we found was that central banks actually had to buy these long-term assets, which freed up money in banks to make new long-term loans. So the supply of long-term funds was increased, and as a result, the interest rates on long-term funds decreased. So whenever you hear people saying that Wall Street was bailed out, but Main Street was not, quantitative easing totally bailed out Main Street by keeping mortgage rates low in the United States over the last 10 years. So here's a quick image that shows you what quantitative easing looks like on the Federal Reserve's balance sheet. It only shows up to about 2016, but it does nicely highlight the point here. You'll notice that in the lead up to the 2008 financial crisis, what we had were a series of short-term liquidity measures that were required to kind of keep things floating. But by the time we get to the end of the year, you'll see massive spikes in terms of both liabilities and assets of central banks. You'll notice that they pick up a lot of this dark area here, which is listed simply as other assets. A large number of assets were purchased by the central bank, and with that money, they created reserves. But you'll notice that there are a couple of key bumps along the path. For instance, here, when you start seeing the central bank buying up mortgage-backed securities. And as they buy up these mortgage-backed securities, you'll notice that there's a substantial expansion of reserves. When we get to QE2 by about 2010, you'll see again, there's an expansion of the amount of assets on the central bank's balance sheet. In this case, it was largely an expansion of treasury bills and bonds, but you'll notice with QE3 that we see a further expansion of the use of mortgage-backed securities. But every time the central bank is buying up more of these assets, what they're doing with it is not issuing more currency against it. The amount of currency has been steadily increasing over time, but the asset that's being created is short-term reserve credit at the central bank, which is this darker orange that you see in the bottom half of this diagram. Now, with the advent of COVID-19, we seem to have taken quantitative easing to a whole new level. It's worth mentioning, though, that central banks, strictly speaking, can buy just about any kind of asset that they want to hold in reserve, but traditionally they have been very, very conservative, looking to hold secure, stable assets that, or at least assets they felt were stable and secure, things like land claims or gold or the debts of highly secured governments that had AA and AAA credit ratings. But given the need for immediate intervention in certain markets, several central banks around the world have actually begun to buy other assets, not just short-term or long-term government debt or mortgages. In fact, in some cases, they've started to buy corporate debts. In other places, they've actually started to buy up corporate equities as well. Now, to get an example of how far back this goes, if we rewind 100, 112 years to 1908, the Aldrich-Vreeland Act in the United States allows national level banks to create currency associations. The reason the Aldrich-Vreeland Act was important in 1908 is you'll remember this was immediately after the 1907 banking crisis that JP Morgan had engineered a rescue for. So in the immediate aftermath, before the creation of a central bank, they attempted to enable banks to band together and to bail one another out and to create the currency necessary to do this. And they were allowed to issue these currencies as long as it was backed by government debt or commercial paper. But this effectively meant that commercial banks were creating currency provided they had enough assets. Now, under that sort of regime, prior to the creation of the US Fed, there were high penalties that were applied. So we noticed that this type of currency creation tool was not actually used by commercial banks until the outset of World War I, when there was a significant liquidity crunch in the early months of the conflict. So there is a tradition of allowing institutions to create more emergency money when it's needed. And we see this being used around the world, particularly in the wake of COVID-19. Since the 2008 crisis, the Bank of Japan has been buying up corporate equity. They currently hold something like $400 billion worth of corporate equity. That sounds like a lot, but it's only about 6% of their total assets, it's worth noting. The ECB, or the European Central Bank, has been buying up corporate debt since 2016. The US Fed finally got in on this starting in May 2020. So in addition to traditional kinds of assets that they might hold, like mortgage-backed securities that carry government guarantees, we actually find a questionable quality of assets beginning to creep onto the balance sheets of central banks in a way that we previously haven't seen over almost an entire century. And the exact implications of this are not clear, mostly when we start thinking about the idea of governments who control central banks that own shares in corporations. Should the central bank be voting these shares to achieve any kind of policy objectives, or should they simply be silent investors? These are all open-ended problems that we face as we start turning to these kinds of unconventional monetary policies in the 21st century. But it's definitely something that we need to think about before it runs away on us and we spark our own inflation.